ITOCHU Corporation is a leading Japanese sogo shosha, general trading company, known for its diversified global operations, strong consumer focus, balanced investments, and impressive financial performance, consistently ranking high globally and showing superior stock returns, making it a significant force in international trade and investment. ITOCHU makes money through a dual strategy of trade, import, export, and business investment, acting as a merchant by connecting producers and consumers, earning margins and fees, while also taking significant stakes in companies for long-term growth, generating profits from sales, investments, and value chain creation across diverse sectors like food, retail, machinery, and energy. Their strength comes from combining points, investments, and lines, trades, to build businesses, focusing heavily on downstream, consumer-facing areas for stable earnings. ITOCHU Corporation's net profit generally grew from 2015 to 2025, reaching record highs in the fiscal year ending March 2025, FY 2025, and into the first half of FY 2026. Driven by a strong non-resource segment, although revenue saw fluctuations with global markets. ITOCHU's rapid net profit rise in FY 2017-2018 was driven by strong performance in key sectors like metals and minerals, higher iron ore, coal prices, ICT, chemicals, and food. Plus the significant boost from the CITIC Limited investment and the absence of prior years' one-off losses. Hitting record highs under their brand new deal plans focused on non-resource growth and cash flow, culminating in a goal to reach 400 billion yen profit. ITOCHU significantly reduced reliance on volatile resource trading, now 90% of operations, focusing on stable, diverse businesses like food, textiles, ICT, and finance, leading to resilient growth. Even its profit drop in fiscal 2021, ending March 2021, wasn't a universal decline but a mixed picture, while core profit faced pressure from COVID-19 impacting textiles, machinery, auto-related, and metals, leading to lower dividends, transactions, extraordinary gains from selling assets, like a stake in CITIC, boosted overall net profit. Though they warned of a 20% forecasted drop in core earnings due to the pandemic's slowdown. Key drags were unfavorable apparel sales, lower auto volumes, and reduced iron ore, coal earnings, partially offset by better energy, chemical profits and massive asset sales. ITOCHU's net profit surged rapidly from 2022 into 2025, primarily due to its strategic pivot to non-resource sectors. Strong performance in textiles, food, ICT, and financials, and gains from asset sales, despite challenges in resource-related businesses. This diversification into stable, consumer-focused areas made them less vulnerable to commodity price swings and drove record profits, as seen in their record H1 FY 2025 results. It generally has a healthy balance sheet, a manageable debt-to-equity ratio, around 50 to 53% recently, robust operating cash flow covering debt, and positive trends in equity and assets. Though its debt level is considered moderate to high by some metrics but well supported by earnings. Its shareholders' equity has generally been growing, reflecting consistent profits, driven by net profits minus dividends and buybacks, as the company focuses on balancing growth investments with risk buffers. It is widely considered to have a robust, or fortress, balance sheet, characterized by strong shareholder equity, low net debt relative to earnings, consistent profitability, and efficient capital management. Strong trading income and net profits. Even amidst market fluctuations, show resilient business operations across diverse sectors like energy, metals, and food. ITOCHU's average return on equity, ROE, has consistently been high, with management aiming for 15% or higher over the medium to long term, achieving around 16% average ROE from FYE 2011 to 2024 and a recent FYE 2025, 15.2%. Demonstrating strong performance driven by profit growth rather than just equity reduction, high return on equity, ROE, and effective asset management point to smart deployment of capital. Supporting its fortress-like financial health. In essence, ITOCHU's financial structure is built for stability, allowing for growth and shareholder returns. A key reason for its appeal in investment circles. ITOCHU's operating cash flow surged from 2018 to 2020 due to strong segment performance, particularly in ICT and financials, food, FamilyMart, and textiles, alongside high iron ore prices, efficient expense management, strategic acquisitions, like FamilyMart as a consolidated subsidiary, and gains from asset sales, all contributing to record cash generation and a strengthening financial position, allowing for growth investments and shareholder returns. ITOCHU's net cash from investing, CFI, fluctuates rapidly due to significant asset disposals, replacements, strategic portfolio shifts towards stable non-resource sectors, substantial growth investments in new ventures, like digital, sustainable businesses, and impacts from foreign exchange, yen appreciation, leading to large cash inflows from selling old assets and outflows from buying new ones, all while building stable, diversified earning. ITOCHU uses share buybacks and dividends as key parts of its capital return strategy to boost shareholder value by increasing earnings per share, EPS, and rewarding investors, recently completing a large 150 billion yen buyback in 2025 alongside regular, growing dividend payments, reflecting confidence in its shift to non-resource businesses and steady cash flow. They combine these methods to show financial strength and improve per-share metrics, balancing direct cash payouts, dividends, with reducing share count, buybacks.